Before we jump into the stock-specific fundamentals, we need to address the stark macroeconomic reality shaping markets right now. We are witnessing a clear tug-of-war between monetary tightening and aggressive AI capital spending.
Exactly, James. On one side, monetary policy is shifting, with new Federal Reserve Chair Kevin Warsh taking a hawkish stance to fight persistent inflation. Bank of America now expects 3 consecutive rate hikes of 25 basis points starting this September. Rising interest rates raise the cost of capital across the board and typically put pressure on tech valuations.
Yet on the other side, big tech is showing no sign of slowing down. The top 5 hyperscalers are guiding to a staggering $730 billion in AI capex for 2026, an 80% jump from 2025, with projections already pacing above $900 billion for 2027.
That divergence is critical. Broad market leadership remains remarkably narrow and heavily concentrated in the AI ecosystem. If high interest rates begin to squeeze broader corporate margins, while market expectations for AI returns stay sky high, equities become uniquely vulnerable to any potential disappointment. That is why understanding the infrastructure leaders driving this spend is more important than ever.
Today we are going deeper into one of those leaders, Broadcom, ticker symbol AVGO. Edward, what is Broadcom and why does it matter for the AI ecosystem?
Broadcom is a global leader in semiconductors, providing essential building blocks for modern computing. While they are known for high-speed Ethernet networking, their custom AI accelerators, application-specific integrated circuits, are what make them indispensable. They design custom silicon tailored specifically for complex AI and machine learning workloads across global data centers.
Give us a quick financial snapshot. PE ratio, revenue growth, margins.
Broadcom trades at a trailing PE ratio around 63, reflecting high growth expectations. Operating margins remain exceptional at over 40%. In Q1 2026, Broadcom delivered an EPS of 2.05, beating estimates by 9%, driven by a 79% year-over-year surge in AI semiconductor revenue.
79% growth in AI semiconductors is massive. Let us talk partnerships. They have a $30 billion chip agreement with Apple through 2031 and recently signed a landmark $200 billion memorandum of understanding with Samsung covering HBM4 memory and 2nm foundry manufacturing. How important are these deals?
They are transformative. While customer concentration carries inherent risk, these multi-year commitments give Broadcom unmatched revenue visibility. Their hyperscale client list also includes Google, Meta, Anthropic, and OpenAI. Next earnings September 3rd, with 48 analysts maintaining a strong buy consensus and an average target of $527, 36% upside from current levels.
What is the bull case from here?
Custom AI silicon is still in its early scaling phase. As tech giants seek alternatives to off-the-shelf GPUs, Broadcom's co-design leadership gives them a massive runway to expand margins and scale their AI revenue toward $100 billion over the coming years.
And the bear case?
Customer concentration remains the primary risk. A small handful of hyperscalers drive the bulk of revenue. If any one of them pulls back on AI capex, Broadcom feels it immediately. Rising interest rates add pressure on broad market valuations, and competition from other chip makers is intensifying as the AI market grows.
What are retail investors missing that institutions already know?
Institutions view Broadcom not just as a chip seller, but as the foundational architecture of the custom AI transition. When Google, Apple, and Anthropic need silicon built exactly for their AI workloads, they come to Broadcom. That co-design relationship creates switching costs that are extraordinarily difficult to replicate.
Now, the CF Global stock score for Broadcom.
Based on our internal analysis framework, this is educational, not a stock recommendation. Revenue growth, 9 out of 10. Exceptional and accelerating. Balance sheet, 8 out of 10. Strong but carries acquisition-related debt. Moat, 8 out of 10. Custom silicon co-design is a deep moat, but not a monopoly like ASML. Valuation, 5 out of 10. Trading at a premium that leaves limited margin of safety. Risk, 7 out of 10. Customer concentration and rate sensitivity are real. Total CF Global Stock Score for Broadcom, 37 out of 50. Overall status, good position.
Broadcom driving AI infrastructure growth through record revenues and landmark partnerships, though customer concentration and macro rates remain key considerations. Next episode, we continue the Stock Deep Dive series. Do not miss it.
And amid all this, do not forget the most important investment of all, enjoying the beauty of life.
No AI, invest in AI. See you next episode.